Assalamualaikum and a very good morning. I be to Professor Umaima and friends. Assalamualaikum and a very good morning. I be to Professor Umaima and my fellow friends. Today we are going to present about issues related to market risk, operational risk, Shariah non-compliance risk, and also rate of return risk, and how to mitigate those said risks. Today's presentation will be presented by me, Muhammad Imam Hakimi bin Muhammad Zamri, Ahmad Syauqi bin Zaidan Rashid, Siti Nurul Syawani binti Hamdan, Nur Salma Amirah binti Abdul Rashid, Nurul Izzati binti Muhammad Suhimi. So, today's presentation will consist of 6 instruments. The first one was abstract, second one was market risk, the third one was operational risk, the next one was Shariah non-compliance risk, and then rate of return risk, and finally conclusion and recommendation. Islamic financial institutions are always exposed to risk, especially Islamic banks. Therefore, a way to mitigate those risks was needed. This study aims to determine the issues that Islamic banks face in market risk, operational risk, Shariah non-compliance risk, and rate of return risk, and ways to mitigate those risks. Market risk can be defined as a potential loss to the bank from the position taken in a contract in which an Islamic bank is subject to ownership and pricing concerns. Operational risk is the risk related to the loss resulting from inadequate or failed internal processes, people and systems, or from any external events. Shariah non-compliance risk is the risk that arises from Islamic bank due to failure to comply with the Shariah rules and principles determined by the Shariah board or the relevant body of jurisdiction of the Islamic bank. Rate of return risk, however, refers to the potential impact towards an Islamic financial institution net income or market value of equity rising from the change in the market rate of return. We use data on the issue that was faced by CIMB Islamic Bank regarding market risk, Al-Rajihi Bank regarding operational risk, Bank Muamalat Malaysia Berhad regarding Shariah non-compliance risk, and RHB Bank Berhad regarding rate of return risk to determine the technique that was used by Islamic banks to mitigate risk efficiently and minimize losses. In CIMB Bank, they use on-balance sheet netting and VAR framework to deal with market risk, while in Al-Rajihi Bank developed its own instrument, which is Risk and Control Self-Assessment (RCSA) and Branch Risk and Control Self-Assessment (BRCSA) to deal with operational risk. Bank Muamalat Malaysia Berhad mitigate Shariah non-compliance risk by giving sufficient training and guidance to its workers, while RHB Bank Berhad mitigates its risk by using 2 standard practice, which are Profit Equalization Reserve (PER) and Investment Risk Reserve (IRR) methods. The results suggest that there were different types of risk mitigation technique and instrument practiced by Islamic banks depending on the risk they were facing.
Assalamualaikum and hi everyone. Firstly, I'm going to present about market risk. What is market risk? Market risk is the potential loss to the bank from position taken in contracts in which an Islamic bank is subject to ownership and pricing concern. Market risk refers to the possibility of losses in, on and off balance sheet position as a result of price fluctuation in tradable, marketable or leasable asset, and off balance sheet individual portfolio, for example, restricted investment accounts. This can happen, for instance, when the bank engaged in a murabaha transaction, which entails the purchase of assets that will sold on a credit basis later. To eliminate business risk, Islamic banks in some jurisdictions, such as in Malaysia, have used the buy-in, sell and buyback contract, which allow the profit rate on the murabaha contract to be competitive with interest rate on conventional loans. Next is about the background of CIMB Islamic Bank. CIMB Islamic Bank is the principal operating company of the CIMB Group's Global Islamic Banking and Finance franchise, which is regulated under Malaysia's Islamic Financial Services Act 2013. It runs alongside the group's universal banking platform and provides Shariah-compliant products and services to the wholesale banking, consumer banking, commercial banking, and asset management sectors. Under the leadership of the CIMB Islamic Board Shariah Committee, which includes some of the world's finest Shariah experts or scholars, CIMB Islamic's goods and activities are managed in strict compliance with Shariah principles. Individual, small and medium-sized businesses as well as large institutional customers can all benefit from CIMB Islamic's comprehensive and innovative Shariah-compliant financial products and services. Next, I'm going to share about the issue in market risk. First, unlike conventional banks, Islamic banks' banking books contain significant market risk as well as credit risk due to trading-based instrument and equity financing. At various stages of transaction, risk mix and change from one type to another. Credit and market risks are present in trade-based contracts such as murabaha, salam and istiqna, as well as leasing. The risks are increased and difficult to mitigate due to rigidities and weaknesses in the infrastructure, institution and tools. For example, in murabaha transaction, when an Islamic bank delivers an asset to a client but does not get the payment from the client on schedule, the bank is subject to credit risk. The bank is also exposed to price and market risk in the case of non-binding murabaha, in which the client has the right to decline delivery of the product purchased by the bank. Another concept described by the State Bank of Pakistan about credit risk in murabaha and musyarakah contract is that the risk inherent in the murabaha contract is changed from market risk to credit risk during the contract life. And also another example is when the invested capital in mudarabah or musyarakah contract is converted to debt due to mudarib or musyarakah management partners proven negligence and misbehavior. Last but not least is the instrument or techniques to mitigate the market risk. One of the techniques to mitigate market risk is by using on-balance sheet netting. These techniques can reduce risk exposure to the net amount between the counterparties, receivable and payables. Netting is preferable for payments between two company subsidiaries. The currency position of receivable and payable can often be matched with non-subsidiary counterparties, reducing the mutual exposure. When it done correctly, netting can eliminate credit risk exposure between the two parties. And also, other than that, CIMB Group uses the VAR framework, in which VAR indicates the worst projected loss in portfolio value under normal market condition over a certain time interval at a given confidence level to quantify market risk. To calculate VAR, the group used a historical simulation approach. Based on the last 500 daily historical movement of significant market and characteristic and a 99% confidence level at a one-day holding period, this approach analyzed the probable loss in portfolio value. Equity risk, benchmark rate risk, foreign exchange risk, and commodity risk are the four key categories of market risk to which the group is exposed. For efficient risk monitoring and control, each business unit is assigned VAR limitation for each type of market risk. As a result, the market VAR generator is vulnerable to the risk that price and rate fluctuation throughout the specified period will not be typical. For example, if the previous 500 daily price movements were seen during a period of very low volatility, the VAR calculated would be understate the portfolio's rise and vice versa. Thank you.
Moving on to the next series, which is about operational risk. It might sound about maintenance or technical because of the word operational, because initially the operational was defined as unquantifiable risk for the past 6 years because the firm or the bank can't calculate. Therefore, Islamic Financial Service Board (IFSB) has defined the operations as the risk related to the loss resulting from inadequate or failed internal process, people and system, or from external event including losses resulting from Shariah non-compliance and failure in fiduciary responsibility. From an Islamic perspective or from IFSB definition, there are 6 components or causes of operational risk. First of all, it's about external risk. External occurrence like external fraud, regulatory regime change, computer hacking, and many more, which is outside or out of control from the Islamic bank. The second source is Shariah non-compliance risk, which will be defined more in detail from my partner Salma. The third source is about fiduciary risk that refer to an Islamic bank's inability to perform in line explicit and implicit fiduciary standard. The fourth risk is about people risk, which refer to fraud and human mistake. The fifth component is about the legal risk. When Islamic bank operate in different country with different legal system, they might face legal suit. And last but not least is about technology risk. As Islamic bank expand with technology and use great software, they might face inability to keep up with technological advancement and fall behind from their competitors. The bank that has chosen is Al-Rajhi Bank, which formerly named Al-Rajhi Banking and Investment Corporation from Saudi Arabia. Al-Rajhi Bank is the world's largest Islamic bank in terms of capital, with over $126 billion assets and over 600 branches in 2020. And also they earned $2.8 billion in profit for 2020. And Al-Rajhi Bank offer all services with Islamic requirement, and the bank was selected to win the Best Retail Bank Award from 2009 to 2012 for the 4 straight years. So regarding about issue in application of operational risk. Operational risk challenge occur when Islamic bank liquidity and risk management alternative as to like bond, option and derivative are limited. With comparison to a conventional risk, Islamic bank do not use operational risk management techniques because they are still in the early stage of operational risk implementation. So Islamic financial are more vulnerable to losses, particularly operational risk, because of their relatively new and less resistant product kinds and tight regulatory standards for Sharia rule compliance. As a result, it was widely assumed that in comparison to traditional financial institutions, they will have considerable stricter risk management procedure. For operational risk, it has a high difficulty or hard to mitigate with external events, as some activities are unpredictable and happen without the company knowing. For example, disaster occurs such as the pandemic COVID-19. Risk is one of the most difficult aspects of operational risk because workers must be knowledgeable about both Islamic and conventional banks. The danger of people in Islamic banks is substantially higher than in regular banks or conventional banks. Islamic bank must be equipped with innovative product developers and innovators who are well versed in Sharia. For example, in Ijarah, rent increases by the lessor in the event of late payment, and Budak Rebah the ability to provide consistent financial performance of the project, and in Istisna difficulty to provide product on time. So Al-Rajhi Bank offer a few risk mitigation instruments and strategies. The group has developed instruments for good practice and successful execution of operational risk management, among other things. To begin with, the group developed a risk control and self-assessment to help managers better analyze the condition of the risk and control environment. They also developed the branch risk and control self-assessment (BRCSA), which is used to examine and apprise operational risk and control effectiveness at branches. The bank devised its own strategy and process to mitigate with operational risk. Begin with an external control system based on job separation, independent inspection, segmented system, access control and multi-tier authorization process. The company or Rajhi Bank create an operational risk management rules and procedure guide in order to reduce user mistake. The method will be followed to guarantee that internal rules, guidelines, control and procedure are followed, as well as those appropriate disciplinary action are implemented against current employees. After that, they will analyze and improve operational risk, limit and management measure on a regular basis, then to limit the risk and manage the effect of loss occurrence. Disaster recovery and business continuity plans are put in place. By incorporating takeover insurance, it will aid in the reduction of risk of high impact loss occurrence. And last but not least, assessing outsources activity to verify that service provider follow the service agreement terms and conditions and that their integrity and service and quality are not jeopardized.
Assalamualaikum and hi everyone, I am Salma and today I will explain in more detail about Shariah non-compliant risk. To begin with, the Islamic financial institution cannot avoid Shariah non-compliant risk, or we call it as SNCR, as it is one of the significant risks faced by them. Not to mention, according to the Islamic Financial Service Board, Shariah non-compliant risk is the risk that arise from Islamic banking due to failure to comply with the Shariah rules and principles determined by the Shariah Board, or the relevant body in the jurisdiction in which the Islamic bank operates. The risk also may develop if Islamic financial institution fails to anticipate, detect, analyze and manage the effect of Shariah non-compliance events that alter the profile of unique risk. As a result, Shariah non-compliant risk can result in legal risk being the failure to comply with contractual obligation, and compliant risk, which is the risk of non-compliance with laws and regulations. Therefore, it is advisable for IFI to absorb the Shariah non-compliance risk into their risk management framework to mitigate it. Moving to the next slide, I choose Bank Muamalat Malaysia Berhad (BMMB) as an example of Islamic banking. This bank is a renowned Islamic bank that was founded on 1st October 1999 and is controlled by the Islamic Financial Service Act 2013. Bank Muamalat, the first ever Islamic financial institution in Southeast ASEAN to be fully recognized as a member of the Global Alliance for Banking on Value on November 15, 2017, which became responsible for a shared mission with other Islamic banks to deliver sustainable economic, social and environmental development. To highlight, Bank Muamalat has offered individual service from deposit accounts, funding needs for automobiles and home and personal use, as well as financial advisory products such as family and general takaful or investment. So aside from that, as we all know, risk is a present in every area of any business operation, and in order to successfully manage it, Bank Muamalat has implemented and integrate risk management strategy to guarantee that a wide range of risk types are examined and managed. In this context, Bank Muamalat defined SNCR as the risks that arise from the groups and the bank's failure to comply with the Shariah rules and principles determined by the Shariah Committee of Bank Muamalat and relevant Shariah authorities committees. Next, we can refer to the diagram shown for the issue of SNCR that may affect Islamic banks. The diagram illustrates the unclear pricing formula that is considered as a medium risk from the Shariah perspective. However, in the context of finance, the impact of the risk is low in terms of financial consequence. And for the following example is conditional in by enough personal financing. And when we discuss about personal finance, we are focusing on the amount of money provided by the bank, which is not particularly large. So from the Shariah standpoint, the intercondition in by al-imnah finance is seen as a serious condition that may affect or jeopardize the contract validity. In spite of that, because the amount involved is so little, the financial impact to the Islamic bank may be small. And last but not least, the use of incorrect language such as interest in business financing contract is not deemed harsh but rather low because it is readily replaced with the word profit. However, in terms of financial ramification, it may be extremely damaging to the financial institution because it may entail a large sum of money in the business financing arrangement. As a result, each of these occurrences may have a direct influence on the profitability of financial institution, both current and future earnings. To prevent SNCR, Shariah compliant financial products should be free or restrictive characteristics such as riba, gharar, which is lack of assurance, and taqrir. So for the next slide, to mitigate the risk, we should identify the risk. So if employees are incompetent, SNCR can be identified. This refers to the employee's inability to manage the activities in the institution, which will result in SNCR. To reduce the occurrence of the error, caused by this aspect, the company management should give sufficient training and guidance to its worker. Aside from that, the product structure can identify SNCR too. And because as we know, Sharia legislation in IFI arrived later than conventional, that's why the method of goods adopted by IFI differ from the usual. In illustration, some aspects of conventional banking are prohibited in Islamic banking, such as loan interest or riba, which is permitted in conventional banking but prohibited in Islamic banking. As a result, the necessity for Sharia review in IFI is critical since they will analyze our corporate process to ensure that no aspect will contribute to Sharia non-compliance activities. Not to forget, the flaw in system technology provide a method to identify the SNCR, which may cause Islamic financial institution to engage in false product promotion. As a result, every transaction or contract must be transparent in order to preserve the right of the contract party. So to mitigate the risk, IFI must develop 4 process or phase. First, IFI must be notified by their Sharia committee. As we know, the Sharia committee is in charge of providing advice and recommendation to the IFI on Sharia related matter. So they will determine if the risk is genuine or possible. So after reporting to the Sharia committee, IFI must also tell BNM to ensure that they are aware of and recognize the risk that is occurring in IFI. Simultaneously, IFI should quickly cease non-compliant operation to avoid being exposed to the same risk in the future. Last but not least, IFI must develop and submit a rectification plan to BNM within 30 days of becoming aware of the risk. However, if they not submit the plan, BNM may take a legal actions against them. So that's all for the Sharia non-compliance piece. I'll pass for the next topic to my friends.
Next, we move to the rate of return risk in Islamic banking. To begin with, the rate of return risk is the risk that the bank will incur a financial loss as a result of a mismatch in the profit rate on the bank's assets and unrestricted investment accounts. The rate of return is not the same as the interest rate. Interest rates cannot be used in the structuring of an Islamic financial product by an Islamic financial institution. The exposure of a bank's financial position to unfavorable interest rate changes is known as interest rate risk. Changes in interest rates can affect a bank's earning by affecting net interest income as well as other investment interest sensitive income and operating expenses. Since its present value of future cash flows or the cash flow themselves change as interest rates fluctuate, it has an impact on the underlying value of the bank assets, liabilities, off-balance sheet and off-balance sheet instrument. As a result, while constructing Islamic contracts, financial institutions utilize an alternative rate known as rate of return, which is based on different benchmarks to reflect the risk triggered by market fluctuation. There are 2 essential aspects that differentiate rate of return risk and interest rate risk. First, because conventional banks operate with interest-based and fixed income instrument on the asset side, the rate of return on investment held to maturity will be less uncertain. This uncertainty is escalated since Islamic banks have a mix of markup-based and equity-based investment. Second, in conventional banks, the return on deposit is predetermined, whereas in Islamic banks, the return on deposit is anticipated but not agreed upon in advance. Furthermore, in the end of the investment period, the return on some investment, particularly those based on equity partnership, is undetermined. To assess the degree of return that depositors will receive, Islamic banks must wait for the result of their investment. Investors can expect to receive equal yields from the bank if existing yields or expected rates of return change throughout this period. Next, I'm going to share about one of the Islamic banks in Malaysia, which is RHB Islamic Bank. RHB Islamic Bank Berhad, which was founded in 2005, is Malaysia's first full-fledged Islamic bank to come from an Islamic banking window operation. It is the major driver of the Shariah business for the RHB banking group, the country's fourth largest banking group in terms of assets. RHB Islamic Bank provides customers with a secure, accessible, and efficient banking experience by leveraging the operational capabilities, commitments, and synergies of the RHB banking group's better network of more than 200 branches. They devote their thoughts and actions to provide their corporate customers with a comprehensive array of lending, deposit, investment, and cash management products. With a compound annual growth rate in the double digit, the bank is one of the Malaysia's fastest growing Islamic bank institution. It was the first to provide the diminished musyawarah equity home financing facility, the first to introduce the Islamic e-financial supply chain electronic exchange, and the first to provide the flexible trade finance, which caters for tangible products and services for trade financing, from pre-shipment to post-shipment financing. Next, we move to the issues of the rate of return risk. One possible impact of Islamic banking's high rate of return risk is displaced commercial risk, DCR. DCR is a risk exposure in Islamic banks and financial institutions that enables the financial institution to remain competitive in the face of commercial pressure. It will pay a better return to its investment account holders by allocating a portion of its share income to depositors. This strategy seeks to keep investment account holders' funds in their account so that they do not withdraw their funds and close their account. Genting Hong Kong, which is involved in the cruise liner industry, filed for bankruptcy on January 18 after being unable to pay its debt. According to the Singapore Straits Times, three local banks, Maybank, CIMB Bank, and RHB Bank were among Genting Hong Kong top's unsecured creditors, with a combined exposure of $600 million, which is equals to 2.5 billion ringgit Malaysia. The underlying issue here is that the three Malaysian banks, as the primary unsecured creditors of Genting Hong Kong, must be clarified to avoid public confusion, and such a matter should not be silenced, particularly by Malay and Islamic party leaders. Some of the questions that have been raised include who approved the approval procedure and why the Malaysian bank granted the credit to a gambling firm. According to Subang Member of Parliament Wong Chen, the majority of these banks' primary shareholders are Malaysian taxpayers saving organisations such as Khazanah Malaysia Berhad, Pemodelan Nasional Berhad (PNB), and Employees Provident Fund (EPF). Even if it does not result in a significant loss for local institutions, their reputation as shareholders may suffer. The government is expected to look after the money of taxpayers. This is because a high proportion of working individuals are EPF depositors. As a result, the public has the right to know whether these unsecured loans were issued hastily, and the institution that approved these unsecured loans must justify their action. Next, we move to the methods to mitigate the rate of return risk. As previously said, DCR is the outcome of the rate of return risk. The attempt to mitigate the DCR has resulted in the establishment of two standard methods in the banking industry, namely the profit equalization reserve, which is formed by setting aside portion of the bank's profit before allocation and calculation of the mudarib holder. The goal of the profit equalization reserve is to stabilize and maintain the rate of return paid to depositors while also smoothing the returns and making them market compatible. This enables Islamic financial institutions to prevent DCR or a huge withdrawal of cash or a bank run. Bank Negara Malaysia has mandated that all Malaysian Islamic banks implement the profit equalization reserve mechanism to mitigate the fluctuation of the rate of a return caused by the flux of income, provisioning, and the total deposit to ensure that the Islamic bank's rate of return remains competitive and stable. Another method is Islamic risk reserve, which set aside some of profit attributable to profit-sharing investment holders, which the bank as mudarib is normally authorized to do in an investment or mudarabah contract. Furthermore, the portion of profit equalization reserve attributable to the profit-sharing investment account and the entire investment risk reserve will be invested in the assets that generate a return for the profit-sharing investment account.
Mitigating a risk was a must-do thing for an Islamic financial institution, not only the Islamic banks, to ensure the trustworthiness of the operation and process followed within the banks. Although risks cannot be avoided, they can be mitigated to a certain extent. Finding the different types of risks and issues that were faced by an Islamic bank and analyzing ways to mitigate them shows the importance of mitigating risks. The needs of a good risk management system can cater to the daily problem of their customers, satisfying all of their customers' needs. This improves the image and practice of Islamic banking in the current days. With regard to the issues, market risk can be mitigated by using the on-balance sheet netting. This technique ensures that there is a low amount of risk exposure to the net amount between the party that received the money and the party that paid the money. VAR framework was also a good method and practice to mitigate market risk. However, due to its vulnerability towards the risk that price and rate fluctuation in a specific period will not be typical, making it less probable to be practiced. On the other hand, instruments like Risk and Control Self-Assessment (RCSA) and Branch Risk and Control Self-Assessment (BRCSA) were good strategies due to their function to examine and appraise operational risk. Analyzing the operational risk on a regular basis will aid in reducing the exposure to the risk of high-impact loss occurrence. Shariah non-compliant risks, however, require 4 phases of process in order to mitigate it. The process starts with informing the Shariah committee, as they will then determine whether the risk was genuine. Islamic banks need to also inform the BNM about the risk so that BNM can recognize the risk, and at the same time Islamic banks need to cease a non-compliance operation quickly to avoid the risk of it happening again to them in the future. And lastly, Islamic banks need to submit a rectification plan to BNM within 30 days of becoming aware of the risk, because BNM can take legal action against them if they do not submit. RHB Islamic Bank Berhad mitigate their rate of return risk by using the off-balance sheet and on-balance sheet technique. The need for a good risk management technique will make an Islamic financial institution earn a legitimized profit. We can conclude that the different types of risk make it essential for an Islamic financial institution to have various different types of instrument or technique to mitigate their risk. Risk management was essential in maintaining business stability and economic health. Although the risk cannot be completely removed, minimizing the risk can be beneficial for an Islamic financial institution. Therefore, the study suggests that the board of directors for an Islamic bank should research, develop, and implement various different types of risk management tools in order to cut short the amount of risk an institution was exposed to. That's all from us. Thank you.